Google just told the world that it's about to spend up to $200 billion on AI this year alone. Tesla is burning cash again for the first time in 2 years, and oil is threatening almost $100 a barrel.
Alphabet shares sank in extended trade as the Google parent company hiked its Capex outlook for the year up to as high as $205 billion as it continues to build out its AI infrastructure. Elsewhere, Tesla shares also coming under pressure in after-hours trade, sliding over 4%. The EV maker saw net income fall 5% from a year ago.
Lots going on in the market today. The NASDAQ and the S&P 500 both down over 1%. Let's get into what's actually happening. But before we get into that, go ahead and hit that like and subscribe button if you're looking to find the next biggest stock and wanting to make money in any market that's going up or down. Thank you so much. Now let's get into it. Okay, guys, so the S&P 500, the NASDAQ, both are down. Oil is spiking, and all AI hyperscalers are spending a ton of money and not really seeing the returns yet. So what is going on? Let's start with Google. They reported solid numbers, they beat revenue, and their cloud services, well, that grew over 82% year over year, or almost added over $25 billion in revenue for the company alone. Sounds great, right? Well, here's what the market absolutely hated. Capital expenditures for one quarter hit $45 billion, and management guided that you can expect within the next year for them to spend in the upwards of $205 billion on AI infrastructure alone, stating that 60% of that is going to servers and the other 40% of that is going to data centers. Now, they raised both debt and equity to help pay for this, diluting shares. So naturally, Wall Street's reaction, well, shares fell hard after hours yesterday. And they're continuing that fall this morning, down over 7%. So investors, well, they're no longer clapping for, let's spend a ton of money on AI infrastructure. They're starting to wonder, are they going to actually see a return on this AI spend? The way I see it, there's actually only a few companies that are going to come out of the other side of this AI spend. And to me, that's Anthropic, Grok, and possibly OpenAI. And of course, there's going to be a few others, like the names who produce storage and compute processing power. And of course, the AI data center names like CoreWeave. Now, this isn't just Google who's spending this money. It's the big four hyperscalers: Meta, Microsoft, Amazon, and yes, Google. What history has taught us is that the ones who are spending the most rarely receive a return on investment that justifies the spend.
More than $1 trillion wiped out from big tech market caps in just the last week as those four large hyperscalers announced they expect to spend more than $600 billion in Capex this year.
Personally, what I would be doing is I would be looking for some of the smaller names that are going to benefit from this over the next decade. You're going to see much higher returns. I'm talking double digits, triple digits. And that's mainly going to be the suppliers and data centers. And then, of course, you're going to have the AI powerhouses once they actually come to market, like Anthropic. But that's going to take some time, and I wouldn't expect them to just burst out once they do actually IPO. Now on to Tesla. On paper, it looks great. They had record deliveries for Q2 with a solid revenue beat. However, when you dig just one layer deeper, you see that adjusted earnings per share came in at only 33 cents per share when Wall Street was expecting 50 cents per share.
You've seen some of that market share in Europe eroded, and you've seen some massive drops in Tesla car sales over the last couple of years in Europe and some of those other markets it operates in where Chinese players are entering the market. So that's been something that has really pressured the auto business over the past couple of years as well. And at the same time, you've seen this big pivot from Elon Musk talking about Tesla is not just a car company, but a company around autonomy, around robotics, around AI, around semiconductors now.
That's a huge delta. They missed by almost 50%. Operating expenses jumped hard, and Capex, it tripled. They spent almost $6 billion last year. And free cash flow, well, it turned negative for the first time in over 2 years. Now, Tesla investors are asking themselves, how much longer can we hold the bag while we wait for all these different segments to turn profitable and actually to realize the promises that keep on being made to them? Optimus, robotaxi, more AI compute. Now, I'm not saying I don't like Tesla. I absolutely love Tesla. And Elon, he's a pioneer in his field. But the stock, it's reflecting what every investor is thinking. And it's down over 10% today already. So, like I said, it's not just Google who's spending a ton of money. It's all the hyperscalers who are spending a ton of money. And even companies like Tesla. The companies right now where to be at are the ones that I talked about in my video yesterday. Like SanDisk, Micron, Applied Materials, Nebius. But these names are going to be volatile. So make sure that you buckle up and you're in for the ride in the long run. Now let's get into the broader market as a whole. While tech is stressing about spending, energy is stressing about supply. Overnight, the Houthis attacked 2 tankers in the Red Sea, and US-Iran threats and strikes are both ratcheting up.
Houthis are saying they targeted 2 Saudi oil tankers in the Red Sea. You had greater than even odds on this happening. It seems like it may be coming to fruition right now.
Let their refiners make some money. They want to chase.
This is not good for oil. Brent crude has been ripping higher and briefly touched $100 a barrel, while WTI is near $90 a barrel. Higher oil equals higher inflation fears, which equals higher yields, which equals a huge headache for the Fed. And the possibility of them not dropping rates for the rest of this year, which is what the market is absolutely terrified about. I mean, the whole reason why Trump brought in Warsh was to drop rates. And if inflation keeps going up and he drops rates, it could be a disaster for the economy long term. So what do you actually do with this? Expect a ton more pressure on the Mag 7 names. The only one that I think is going to have some resilience is going to be NVIDIA. This whole spend whatever it takes narrative is being stress tested hard right now. Now, energy has the clearest tailwind right now. Tickers like XLE, Spider's Index Fund for Energy, and other names like Valero, Marathon Petroleum, and Phillips have all been ripping hard the past few months. So the midterm question is, can those 4 hyperscalers actually turn in some profits? Or are they just going to keep spending money to the point where it takes years for their stocks to recover? Same thing with Tesla. How much longer can investors hold on to the promise of these robotaxis? I mean, it's been years that they've been talking about these robotaxis with no deliverance yet. And of course, it's going to take some time. But that's really what the long-term vision is Optimus and these robotaxis to actually make Tesla some money. And the last, probably most important thing to watch is energy prices right now and what the Fed is going to do. If prices are hovering between $90 and $100, interest rate cuts, you can throw that out the window. It's not going to happen. So what do? The smart money, it's already rotating. They're rotating out of those names that I just mentioned and rotating into the energy stocks. Now, I don't think this is going to be a long-term thing. I think it's going to be a midterm thing, and we need to watch inflation and what the Fed is actually doing about it. But I do think that there's going to be some smaller hardware names in the AI space where you can get into now still and see some profit in the short and midterm. As always, keeping you guys informed on the market today. Go ahead and hit that like and subscribe button if you're looking for the next biggest stock or wanting to make money in any market, rather up or down. Thank you so much, guys, and see you next time.